Welcome, friends. In this series of simplifying financial jargons, today we'll simplify one another terms, REITs or real estate investment trusts. So, what it is, how it functions, and who can invest in REITs. How an investor can get benefited out of REITs and have diversified portfolio. REITs or real estate investment trusts are companies that own and operate income producing real estate. Some REITs not only operate but also finance real estate. So we can see here broadly two, or you can say there are three types of REITs. One type of REITs or real estate investment trust own and operate their real estate. It may be different type of real estate owning, maybe a warehouse, shopping mall, commercial properties, commercial offices, hotels and resorts, healthcare facilities. So any different types of, and from there they are getting income through rental income or maybe some other types through advertising or anywhere. So from there they are getting. So such type of real estate investment trust are known as equity REITs. There are also another type of real estate which just now we discussed, which operate by investing, or we can say mortgage the commercial properties or the real estate and provide loan directly to owner or operator. So indirectly they can have or can acquisition, through acquisition they can manage and get income. So that type of REITs is known as mortgage REITs. They are specialized in providing loans and managing indirectly or through acquisitions of such properties. There are third type, which are amalgam of both equity rate and mortgage rate. So some portion will be in direct owning and operating, and another part will be financing of loans, and through acquisition they are really working. One thing I would like to clear here, to be a REIT, a company must distribute at least 90% of its taxable income to shareholders annually in the form of dividends. It is very much necessary that they should be distributing whatever they are earning, and from those earnings there will be taxable income, and 90% of that should be distributed annually through dividends. First of all, REITs was conceptualized and started in United States of America through legislation of US Congress. So from 1960 it was came into existence and started operating there. From 2001 it was included in S&P 500 as a stock and started trading also there. So Standard and Poor recognized officially and make part of S&P 500. So where they can invest in any type of real estate, maybe directly owning or through providing loans. So what are those properties where they can invest? It may be apartments, residential apartments, or hotel apartments, office properties, commercial offices properties, shopping centers, shopping or malls, storage centers and warehouses. We can see nowadays there are so many warehouses coming across the Delhi NCRs. So there may be industrial parks, hotels and resorts, healthcare facilities, etc. So there are wide range of real estate available, and they can invest directly or own and operate. They can also through mortgage can be done all these places. Now another question is how NAV is calculated and how a retail investor can invest there. So NAV, like NAV here, REITs have some property, some assets. So the REITs total assets minus liabilities, if any liability, of course there will be some liability. So total assets minus liabilities and divided by shareholders equity. So if we divide this, the REITs total assets minus all liabilities divided by all outstanding of the REITs, that will yield to NAV or NAV formula. So this is the formula to calculate a NAV, and each REIT will have a definite NAV, and anyone can invest in real estate through this NAV. Whatever unit they want, they can invest whenever that is launched, or maybe it is traded in the stock exchange. Then there they can also invest these REITs mutual funds. One thing more also I want to add here, ki whether they are having tangible assets. Yes, they are having tangible assets, quantifiable assets, physical assets, and through rental income, they generate this income and distribute those incomes to shareholders. And it is managed by a specialized fund manager who have plenty of real estate knowledge and have worked extensively in real estate. Such fund manager uh, manages this real estate, and there is ample liquidity as it is traded at stock exchanges. So there is no need to be afraid of keeping real estate, it will be illiquid. No, there is no dearth of any liquidity as it is traded at stock exchanges, and there is guidelines, complete guidelines through SEBI, which provides this and monitor. So there is complete transparency, and being transparency, anyone can invest. And we have already discussed earlier this multi-asset allocation fund, where we have seen that there is requirement of three asset class. One is equity, debt, and third may be gold or real estate. So through multi-asset fund, one can invest. But if somebody wants directly that portion they want to keep aside, equity separate, debt separate, and this real estate part, they can invest through REITs. As you know, all such type of properties this have large value. So it is very difficult for a retail investor, a small retail investor, to invest in such properties. So how they can? They can go through REITs mutual fund and they can purchase at this NAV, whatever NAV of that very REIT, and have their investment, diversified investment in real estate. As per their liking, they may go for equity REIT, maybe mortgage REIT, or hybrid REITs, whatever they are liking. Another thing, they provide large basket of investment as per liking, even in equity. If someone wants only in offices properties, commercial offices only, they can choose, or shopping malls, they can choose only such RIT. Some specializes in IT parks, they can use. In those parks, they can invest there as per their competence, as per their liking. They have different choices. Investor have multiple choices now available in REITs, and they can invest. Even they can invest in their own city only, where they can go and physically check how the condition of this mortgage property or direct owning and operating, how they are operating. One thing I would like to add here also, if R- RET company acquires any properties, mortgage property, they can enhance value by adding some capex, by renovations, this maintenance of the building. Then it will look like a nice. They can build some surrounding infrastructure, and it will increase the NAV. Of course, it will increase the rental value of that properties, and investor will get more value. Now, how the investor will get benefited? There are two ways. One, through income, whatever income is produced by that very properties, they will get as a dividend, regular dividends. And second thing, the value of that properties keep appreciating. So as per appreciation of the value, they will get both direct income and second appreciation. Whenever that property is sold, they can, or as it is traded on a stock exchange. So as per rental value increase and appreciation of the property value, NAV increasing, and one can sell anytime whenever they want and get both value, direct rental income and appreciation value. So these are from today. If you found some value in this discourse, in this conversation, please do like and provide your valuable comments. I go through each and every comments. And if you have any question regarding any financial jargons related to a stock market or mutual fund, do write to me. Provide, provide your comments, and I will try to cover them in coming videos. You can also share with your friends and colleagues so that they can also get this valuable knowledge. Please also subscribe to this channel so that you can get instant notification whenever I'm posting new videos. Thank you. Bye bye.